Wow, what a day we had yesterday. The Bank of England and ECB meetings came to similar conclusions. They both left policy unchanged while they both introduced forward guidance, and they both made dovish comments about the outlook. Now this concept of forward guidance is very important. If you'd like a detailed explanation of what it is, please look on our website, IronFX.com, go to Research and Analysis, then IronFX blog, and in the IronFX blog you'll see a tab for Word for the Day. Forward guidance is naturally the word for the day today. Now it's a huge change for the ECB, which up to now has stressed that it never pre-commits. On the contrary, yesterday it committed to keeping rates at present or lower levels for an extended period of time, which ECB President Draghi more or less stated was longer than a year. Both central banks also came out, as I said, with dovish statements about the outlook. Draghi said at his press conference that the Governing Council had an extensive discussion about a possible rate cut, that both the refi rate and the deposit rate, which is currently at 0, can go lower still. As a result, both the sterling and euro weakened, with sterling weakening more than the euro. I think both of them are likely to weaken further against the dollar on a fundamental view, as these central bank policies are so different than the Fed's. The Bank of England and the ECB are just now starting to launch a new round of easing measures, whereas the Fed is starting to exit from its easing measures. Today, of course, the focus is going to be on the non-farm payrolls for June. Consensus forecast is for 165,000. It's a bit less of a rise than 175,000 in May, although some people have been revising up their forecasts following the better-than-expected ADP report. The standard deviation on the market consensus is 18,000, so anything between, say, 150 and 180 should be within the range of expectations. A number below that will probably diminish expectations of tapering and be negative for the dollar, while above that is likely to accelerate expectations and boost the dollar further. Now, that's what should happen. But looking at the market's reaction to the data over the last year, euro-dollar has actually tended to fall more when the non-farm payroll misses expectations than when it beats expectations. In fact, euro-dollar has tended to rise in the first couple of days following a beat, which is nearly incomprehensible. It may be that the response occurred when the market was in a risk-on equals sell dollar paradigm, and therefore the market reaction might have been the opposite of what it would be now. So past performance is probably not a good guide to today's performance. I think given the Fed's commitment to tapering off and the ECB's commitment to keeping rates low, we should get a more textbook reaction today. For euro-dollar, trendline resistance today is at 129.20. Key support levels are seen until 128.55, with a break of this level likely triggering a breakdown to 128 the figure. A close below 128 the figure would complete the symmetrical head and shoulders formation and signal a steeper down move. Should the employment report prove disappointing, though, key resistance comes in at 130 the figure, with the tested 130.30 level seeing downward sloping trendline resistance for the day. This is Marshall Gittler, head of Global FX Strategy at IronFX, wishing you solid trading.